Welcome to Turning Hard Times into Good Times. I'm your host, Jay Taylor, and as I like to remind you each and every week, I'm also the author of a newsletter called Jay Taylor's Gold, Energy, and Tech Stocks, and we're having a lot of fun these days with gold mining shares. I can assure you of that. You may want to check it out at miningstocks.com to learn more about my newsletter, Jay Taylor's Gold, Energy, and Tech Stocks. And Chen Lin, my partner, is also doing very well with What is Chen Buying, What is Chen Selling. Go to miningstocks.com to sign up for either of our newsletters. I want to thank each of you for listening to this show, making it one of the more popular shows on the Voice America Business Channel, and also encourage you to send your questions and ideas along to questionsfortaylor@gmail.com, questions4taylor@gmail.com. We do also want to thank our sponsors for making this show economically viable. Our sponsors for this week's show: Trimetals Mining, Coral Gold Resources, Auryn Resources, Brazil Resources, and Columbus Gold. We do have a very busy schedule today, so we'll hop right to it. I've titled today's show, Alan Greenspan Suggests a Gold Standard, and Ron Paul Responds. Well, towards the end of today's show, at about 3:35 to be exact, New York time, I will be playing part 2 of my interview with Ron Paul, which was recorded on June 29th. Dr. Paul addressed comments by Alan Greenspan regarding Greenspan's concerns about inflation and his comments on Bloomberg Television recently, implying that a return to the gold standard might just be a good idea. So my discussion with Dr. Paul will be aired, as I say, at about 3:35 New York time. And I have found the work, though, beyond a doubt, the work of Michael Oliver, especially as it relates to some of the things that Alan Greenspan said, his concerns about inflation. I found Michael's work on the T-bonds to be especially interesting, and it has really caught my attention. We are going to talk to Michael in about 10 or 12 minutes or so from now, to ask him what he's seeing now in the T-bond market, because if the T-bond market is if it's in a blow-off phase, as Michael suggests, after a blow-off phase, you get a reverse action, which would mean interest rates would rise. Well, what's going to happen in a market like this one, an over-leveraged, extremely leveraged global economy, if interest rates start to rise, and what might that mean for the future? How might that relate to inflation? These are some of the ideas we want to talk about with Michael. And actually, I'm going to, in just a minute or two here, I'm going to listen to a hyperinflationist, John Williams, going to talk to us about his views on both Michael's remarks, Michael's view on the markets, as well as Alan Greenspan's discussion, too. Alan Greenspan is worried about impending inflation. He's looking at M2 as a warning signal that we could be heading towards some significant inflation. Well, it doesn't seem to wash very well with a bond market that is hitting new highs and interest rates that are collapsing. If interest rates are collapsing, how could we be looking at inflation in the future? Well, we want to talk to Michael Oliver about his views on commodity markets as that might relate to inflation. We're going to hear Dr. Paul's response to Alan Greenspan. But right now, I would ask my engineer to go ahead and play a clip. I actually recorded John Williams to get his take on his views on hyperinflation with respect to the recent remarks by Alan Greenspan and also Michael Oliver's work. So go ahead and please play my discussion with John Williams this weekend.
Thank you, John, for taking time to take my call today. You've been known for your hyperinflation call. While it has taken longer, I suspect, than you initially anticipated, there are several factors, in my view, that seem to suggest that we may be getting much closer now to what you have been expecting, given your view that it will be a dollar collapse that triggers hyperinflation in the U.S. I believe that's what you've said in the past. And not only in the U.S., but I think you believe it will be a global phenomenon. Let me tell you what I think, and then I would like to get your response, and also to get your own thoughts as to where the global economy is now with respect to your call for hyperinflation. First, let me say Michael Oliver, who is on this show frequently, in fact, will be following you in just a few minutes. His structural analysis, momentum structural analysis, I find is second to none when it comes to picking major turning points for major markets and smaller markets too. But recently he made the call that we're entering a blow-off phase for the T-bond. In other words, we're going to see the 30-year U.S. Treasury go to levels that are just outrageously high, and that means interest rates will go to levels that are outrageously low. And I'm, given Michael's history and also the performance since he made that call, I'm pretty much taking that as a given. And then he notes that once you get a blow-off in a market, you always get the opposite. The market reaches its peak and then it reverses, which then would mean, of course, we're going to start seeing higher interest rates. Now, you can only imagine higher interest rates in a global economy that is so over-levered as this one is will be a disaster. Ron Paul told me a few weeks ago that will be the end. That will be the end game, he said, when that happens. It will be all over. If rates begin to rise just a little bit, I would think it would cause trouble. And you could see the equity markets collapsing, I think, and you could see the debt markets also really taking a hit, a big hit. If the T-bond market takes a hit, I can only imagine what happens to the junk bond market. So, at that point, then, in my view, is the federal government or the central banks will have nothing left to do but to perhaps issue enormous amounts of money, helicopter money, handed out to the masses perhaps, so that they will start to spend money, and then I would think the dollar will be lost, the confidence in the dollar, the confidence in the system, a massive rise in inflation because the dollar loses its purchasing power. What are your thoughts about that scenario? Is that a viable outcome with the way things are shaping up now?
I think we're heading in that general direction. Indeed, I've been looking for a hyperinflation here to kick in before this, but there are a variety of things that have happened, very unusual circumstances, the key point of which was back in 2008 when the banking system was literally on the brink of collapse. They weren't kidding about that. At that point in time, the Federal Reserve, the Treasury, U.S. government decided they would do whatever they had to do to keep the system from collapsing. The Fed's primary function in life is to keep the banking system afloat. It's not to keep the economy growing at a certain pace or inflation at a certain level. They've got to keep the banks going. So what they did was quantitative easing, which did very little, if anything, to help the economy. It's never designed to help the economy. It's helped to keep the banking system afloat. All the treasuries they bought out had the effect, actually, of monetizing about 75% of the U.S. Treasury, the current debt issuance at the time. The Treasury is having some issues as well with the economy, and it worked well from the standpoint of providing liquidity to the Treasury, providing liquidity to the banking system. It didn't do anything for the average guy and did nothing to help the economy. At the same time, the dollar was dropping, which tended to be inflationary, but they wanted to pull that around. They wanted to draw some cash into the dollar. So what they had to do is to make people think that interest rates are going to rise. They did pull back from quantitative easing to the extent that they stopped purchasing treasuries. They didn't liquidate what they held. They keep rolling those over. And then they notched interest rates higher back in December by a quarter point. And all that's going to happen is going to be a quarter point every couple of months. And all that now has disappeared. The problem is the economy. The economy collapsed literally into 2009, and then it never really recovered despite the headline reporting, and now it's beginning to turn down again. And we're seeing that in a number of indicators, and the Fed sees that. The problem, although they'd like to have the economy strong, is that this also means intensified liquidity problems for the banking system. The banking system's not out of the woods. And with the other problems around the world, in China, Japan, South Korea, not buying U.S. Treasuries, you have something of a big issue here for the U.S. Treasury going forward with its funding needs, because with an intensifying recession, their revenues are going to be down, their spending is going to be up, the budget deficit widens, they have to borrow more money. So the happy solution, although it's not so happy, is that where the Fed made the decision back in 2008 to save the system, they're going to continue to do so. And that means they're going to have to revert back to quantitative easing, buying more treasuries, and where all the hype and the talk about, we're backing off the quantitative easing, we're raising rates, that helped to prop the dollar. But when it's clear we're going back to the quantitative easing, you're going to see heavy selling against the dollar. And with that, you're going to see a sharp spike in interest rates. The direct inverse relationship between the value of the dollar and what happens to oil prices. The dollar strengthens as it had until recently. That tends to knock oil prices down. But when the dollar starts to weaken, oil prices rise, gasoline prices rise. That starts to give you a good basic underlying inflation rate in the consumer inflation, and one factor builds on another, and you're off to the races. In response to that, if the Fed goes to the quantitative easing, which I think is what they're going to do, forget a hike in rates again. They're going to be moving into quantitative easing possibly by the election, if not probably shortly after the election. That will have the effect of scaring investors out of the dollar. Now, the immediate reaction, what's the Fed doing? Be buying treasuries. That would knock down the interest rates, which is what we're talking about.
Yeah.
But when the inflation starts to rise, the market forces are in the bond market are killed by inflation. Higher inflation rates rise. So it actually gives you the scenario that you're looking at there.
Yeah, exactly. And so the markets will rule over the Fed, and then won't there be a tremendous loss of confidence in the Fed, I would think, and in the dollar? And wouldn't that very likely turn over the velocity rate if people start to have a loss of confidence in the dollar? I can remember, John, in the 70s when interest rates were rising, the Fed was trying to tighten, and they continued to rise. This is sort of the scenario that you're describing potentially. The Fed could try to be accommodating, but they can't accommodate fast enough to drive rates down.
They've lost. They lost the game back in 2008, and they've never figured out how to get around that. The system should not have come to the brink in 2008. We should not have gotten to that point, but we did.
Yeah.
And we got to that point because of a lot of mismanagement at the Federal Reserve and various levels of the federal government. But once there, they couldn't let the system fail. They just didn't have a way out. All the actions they took to prevent a collapse of the banking system were stopgap. They did nothing or very little in terms of underlying fundamentals to address the circumstances, such as the long-term solvency questions of the United States or the contracting economy. They did very little to turn the economy.
Yeah.
Yet the economy is still turning down, and it's right now turning down at a pace that's probably going to be recognized as a new recession within a couple of months.
Yeah, well, with a tremendous amount more debt on the books as well overall, and corporate debt too has risen very dramatically as corporates have gone out and taken advantage of this cheap dollars or cheaper lower interest rates to borrow to prop up their share prices and so forth. Well, John, I want to ask you one more question here. When you just another minute or so, Alan Greenspan recently voiced concerns when he was asked what is he watching mostly what index what sort of indicator is he watching. He said M2. He said M2 has been creeping up and he's concerned about inflation. Do you think he's seeing what you're seeing?
Well, there's good reason to be concerned about inflation. The Fed back in 2006 stop tracking M3, which is a broader measure. And some of the growth you've seen in M2 has been money moving out of M3 into M2, such as the large time deposits and such. But even with M3, you're seeing enough of a growth rate here. It's beginning to pick up again last month or two to be concerned about inflation. It's inflation. The inflation problem will come right now with the dollar. That's where they contained the inflation in the last 2 years. That's where it's going to break apart next, and you're already seeing it in the price of gold. Markets are anticipating what's happening here. Look at gold. Gold's your ultimate hedge here against what's going to happen to the purchasing power of the U.S. dollar.
Yeah. Well, I want to thank you very much, John. It is about all the time we have. I want to have you come back and so we can talk to you more at length about what's going on in the economy. I know one of your issues in the past has been this whole demographic mess that we're getting ourselves in with an older and older population. Baby boomers now starting to suck the life out of the economy, in essence, no longer producing and so forth, and that's another issue. But I just want to get your thoughts on this because one last real quick question. what is the timing then? I mean, I guess it's impossible to say. What I see with Michael Oliver's blow-off scenario, T-bonds, just blowing off here, interest rates collapsing, and at some point, if there is a turnabout, which seems to happen after these blow-offs, then it tells me that we could be getting fairly close to some very dramatic action here in the markets. Your thoughts?
I would bet on the near term as opposed to the long term. Just look at the Fed behavior.
Yeah.
Go back a month or two. We're going to raise rates next month. Going to raise rates 2 months. They
never do.
Right down the road. All of a sudden, they backed off, almost panicked. We can't do it. Can't do it. Not going to happen. They know what's happening. They don't have a way out. They wish they did. They're going to do what they will do is whatever is necessary to keep the banking system afloat. It means quantitative easing. It means debasement of the dollar. It means higher inflation. They'll take that over losing the banking system anytime.
All right. Well, thank you very much for your thoughts, John, and we will have you back again sometime if you're willing and able to come on. So,
sure, Jim. Thank you very much for having me.